We tend to think that losing money in the markets is a math problem, a miscalculated risk, a poorly timed entry, or a balance sheet we simply failed to read closely enough. We look for formulas, we chase charts. We study earnings reports down to the decimal point, convinced that financial failure is just a failure of data. Yet, some of the sharpest minds in history, engineers, mathematicians, and executives with extraordinary intellect, have walked into the financial arena and lost everything. Not because they lacked information, but because of something much quieter, much more invisible, and infinitely more dangerous: a silent flaw hidden deep inside the human mind. What if the single biggest threat to your wealth has nothing to do with the economy, the Federal Reserve, or the stock market itself, and everything to do with how your own brain reacts to uncertainty? If you have ever felt that quiet pull of regret after a missed opportunity, or the sudden surge of panic when a portfolio turns red, then consider this a critical turning point. Because what you are about to discover changes everything you thought you knew about money, risk, and human behavior. Make sure to hit subscribe and leave a comment below with your thoughts as we uncover the psychological trap that catches even the smartest investors off guard. We live in a culture obsessed with action. From the moment we open our digital devices, we are fed a relentless stream of noise, blinking charts, breaking news alerts, and urgent opinions telling us to buy, sell, adjust, or react. We are conditioned to believe that movement equals progress. If your money isn't moving, you are falling behind. If you aren't constantly checking your positions, you aren't paying attention. It feels productive, almost responsible. Yet, when you look at the individuals who have built legendary generational wealth over decades, a strange pattern emerges. They spend most of their time doing absolute nothing. They sit in quiet rooms, they read annual reports. They wait for years, sometimes decades, for the exact right moment to act. To the modern observer, it looks like boredom, but to the behavioral economist, it is the ultimate masterclass in emotional discipline. Consider how the human brain is wired. For hundreds of thousands of years, survival depended on immediate reaction to environmental threats. A rustle in the bushes meant run, a sudden change meant act. Our evolutionary wiring hates stillness. It interprets inaction as vulnerability. When you translate that primitive survival mechanism into the modern financial world, disaster follows. The market becomes a psychological mirror, weaponizing our deepest fears of missing out and our sharpest pangs of regret. We buy because everyone else is moving. We sell because the crowd is panicking. We mistake the frantic pulse of our own adrenaline for market insight. This is where the greatest illusion in finance takes root. We assume that investing is a test of intellectual horsepower. We believe the person with the most complex financial model wins. History tells a very different story. Time and time again, brilliant intellects have been utterly humbled by simple emotional blind spots. Think about long-term capital management. In the late 1990s, that fund was managed by some of the most decorated minds in financial history, including 2 Nobel laureates in economics. Their mathematical models were marvels of modern engineering designed to capture microscopic market inefficiencies with absolute precision. For a while, it worked brilliantly. The math seemed invincible. Until reality didn't follow the equations. A sudden, unexpected global shock hit the markets and the models fractured. Because they were leveraged to the hilt and blinded by their own intellectual certainty, they couldn't adapt when human panic overrode statistical probability. A multi-billion-dollar fund collapsed in a matter of weeks. The math was sophisticated, but the behavioral design was fatally flawed. This brings us to a profound, uncomfortable truth: investing success is not about how much you know. It is about how you behave when things get uncomfortable. And comfort, in the financial world, is a rare commodity. Think about the last time you watched an asset you own drop significantly in value. What was your immediate physical sensation? For most people, it isn't calm analysis. It is a tightening in the chest, a sudden spike in heart rate, a mental whisper telling you to cut the bleeding, to just make the pain stop. That is your biological alarm system taking the steering wheel. At that exact moment, your brain stops evaluating the underlying business, the economic moat, or the long-term compounding potential. It stops thinking like an owner and starts reacting like a prey animal cornered in the dark. And this is precisely where the biggest mistake begins. People confuse the price of an asset with the value of the business behind it. When the price falls, they assume the underlying reality has shattered. They project their emotional anxiety onto a corporate balance sheet that hasn't changed at all. It is like owning a wonderful home in a wonderful neighborhood and suddenly panicking because a real estate agent walks by and casually shouts a lower valuation through your front window. The house hasn't changed. The roof doesn't leak any more or less than it did yesterday. The rooms are still the same. Yet because someone shouted a lower number, your entire emotional state shifts. You are ready to sell the keys for pennies on the dollar just to escape the anxiety of the fluctuation. Why do we do this? Because uncertainty is physically exhausting. The human mind craves narrative closure. We want guarantees. We want to know what next Tuesday looks like, let alone the next 10 years. When the market refuses to provide certainty, we invent our own stories to fill the void. We tell ourselves that this time is different. We convince ourselves that we are being prudent by cutting losses, when in reality we are just surrendering to our own impatience. Warren Buffett once observed a simple truth about this phenomenon. The stock market is designed to transfer money from the active to the patient. Notice the phrasing, not from the unintelligent to the intelligent, not from the uninformed to the insider, from the active to the patient. That distinction cuts straight to the core of behavioral finance. The greatest hazard in building wealth isn't a lack of brilliance. It is the inability to sit quietly in a room and do nothing while the world around you loses its collective mind. Think about how counterintuitive that is. Every other aspect of modern life rewards constant optimization. If your car isn't running efficiently, you tune it. If your career stalls, you hustle. If your health dips, you change your routine. Action is rewarded everywhere, except in long-term investing. Here, every action carries a cost. Transaction fees, tax implications, and most destructively, the emotional friction of second-guessing your own decisions. Every time you interfere with a compounding process, you reset the clock. Every time you let temporary emotion dictate capital allocation, you hand your leverage over to someone with a cooler head. Yet knowing this intellectually and living it practically are two entirely different universes. Why is it so impossibly hard to just wait? To answer that, we have to look at how we measure progress. We live in a world of instant feedback loops. You tap a screen, food arrives, you send a message, it delivers instantly, you post a photo, likes accumulate within minutes. Our brains have been rewired by modern technology to expect immediate validation for every input. Then you enter the world of long-term compounding. Compounding is, by its very nature, painfully slow at the beginning. In the early years, your capital grows in near silence. The curve is flat, it feels like nothing is happening. You look at your portfolio month after month and the numbers barely budge. It feels like failure, it feels like a waste of time. This is the psychological danger zone. This is where most people abandon a brilliant strategy not because it failed, but because they simply grew bored or anxious watching the paint dry. They pull their capital out, look for something faster, something more exciting. And in doing so, they miss the exact moment the exponential curve starts to bend upward, because compounding doesn't reward constant motion. It rewards quiet endurance. Imagine planting an oak tree. For the first few weeks, you see nothing above the soil. For the first few months, maybe a tiny green shoot appears. It looks fragile, insignificant. If you were impatient, you might dig it up every week to check if the roots are growing. Of course, if you did that, the tree would die. The growth happens underground, away from view in the dark and the quiet. Wealth creation works with the exact same invisible mechanics. The most powerful economic moats, pricing power, customer loyalty, brand compounding, and network effects, do not explode overnight. They thicken slowly year after year, hidden beneath the daily noise of market fluctuations. When you understand this, your entire perspective on risk shifts. Risk is no longer about volatility. Volatility is just the price of admission. It is the weather report. True risk is the permanent impairment of capital, and more often than not, that impairment doesn't come from a bad business. It comes from bad behavior driven by panic, impatience, or the desperate need for constant stimulation. Think about how people approach buying a home versus buying a share of a business. When someone buys a house, they don't call a real estate broker every single morning to ask for a new appraisal. They don't panic if the housing market dips for 3 months. They move in, they paint the walls, they live their lives. They give the asset time to breathe. Yet put those same people behind a brokerage screen and suddenly they are checking prices 3 times an hour, ready to abandon ship over a minor headline. Why? Because liquidity is a double-edged sword. The very feature that makes financial markets so attractive, the ability to buy and sell instantly, is also the primary engine of behavioral self-destruction. Because you can act instantly, you feel like you must act instantly. The ease of the transaction bypasses the friction of reflection. This is where the masters of long-term investing differ fundamentally from the crowd. They build artificial friction into their process. They create mental moats around their own decision-making. They don't check prices daily. They don't listen to the hyperventilating anchors on financial networks. They focus exclusively on one thing: the long-term durability of the underlying economic engine. They ask themselves simple, profound questions. Will people still need this product in 10 years? Does this company possess pricing power that can outrun inflation? Is management allocating capital wisely, or are they chasing vanity projects? Notice what is missing from that list. They are not asking, what will the stock price do next Tuesday? Because they know that trying to predict short-term price movement is like trying to forecast the exact shape of a cloud 10 minutes from now. You might get lucky once or twice, but build a life around it and the wind will eventually break you. Instead, they anchor themselves to certainty in a world built on fluctuation.